Welcome to the Tax-Exempt Retirement Planning Masterclass. I will be your host, Scott Shelley. I am the CEO of Apollo Risk Management and the creator of the Protect and Prosper portal. Within this module, we will be learning about tax-exempt contracts as a superior alternative and comparing them to savings in a traditional 401k plan. With no income or contribution limits, this is an excellent alternative for high-income families who cannot access the Roth IRA to contribute to a vehicle that will allow them tax-free income in retirement and lower long-term investment costs. But before we get into the module, let's look at key lesson number 1. Taxes will represent the largest financial loss most successful individuals will endure during their lives. The less you lose along the way, the more you'll have in retirement to play. There are 3 primary ways to save for retirement. 1. Non-qualified taxable accounts. 2. Qualified tax-deferred accounts. And 3. Tax-exempt accounts, which we're going to cover in this module today. Non-qualified accounts are going to be your brokerage accounts. They're going to hold stocks and bonds and mutual funds, ETFs, and things of that nature. They are going to be taxed based on the hold time and personal income bracket. You can use losses to offset gains, and if you own an investment for less than 1 year, it's considered short-term capital gains, meaning you'll pay tax at your personal income tax bracket. If you hold that investment for longer than a year, it's considered long-term capital gains, and you'll be taxed at 0, 15, or 25%, depending on what your personal income tax bracket is. Non-qualified holdings allow you to control your tax on assets as long as you control the hold time. You have liquidity anytime, and you can have a line of credit attached to these accounts. It's available but not necessarily guaranteed. Qualified accounts are going to be retirement accounts such as IRAs, 401ks, and 403bs. These are going to be tax deferred until you withdraw the money. The taxes will be paid at your federal or state income tax rate at that time, and you cannot use any losses to offset your gains in the account. So you'll pay taxes on all of the withdrawals coming out of the account. There's no liquidity or line of credit available, and withdrawals before the age of 59 and a half are highly penalized by the IRS. Qualified accounts are highly regulated by the IRS and Department of Labor and impose the highest tax rates on withdrawals during retirement. Tax-exempt accounts are structured life contracts known as Index Universal Life Policies that comply with the Internal Revenue Code 7702. These are tax-exempt growth and distribution vehicles. There's no tax to access the capital. You have liquidity at any age, and you have a guaranteed line of credit on the cash values indefinitely. Qualified accounts entice participation with the lure of a tax-deductible contribution. However, with that deduction comes the promise to pay taxes on withdrawals in the highest category of taxation in the future, ordinary income. These type of accounts put the IRS in control of your tax future. And with that brings us to key lesson number 2. It is far more lucrative in the long term to pay tax on the seed rather than the harvest. So when we take a deeper look into the government's plan, we look at a 45-year-old who's deferring $25,000 per year into his retirement account. Over the next 20 years, he's going to avoid paying $150,000 in tax while working, only to pay an estimated $600,000 of tax in retirement when he's not working. Who would have thought that? Qualified accounts entice participation in mutual funds and target date funds within the plan. And with that participation comes large allocations to poor performing asset classes. When we break down and look at the standard target date fund for investors in their 40s, 50s, and 60s, we find 45 to 65% of the portfolio in asset classes that historically have returned less than 2 to 4% over a decade. It's a horrible way to save for retirement. On average, we are looking at a 7 to 10% annualized opportunity loss between domestic equities and the foreign and bond allocations. And it's perfectly clear from the results of 2022 that this allocation theory is not providing any meaningful protection from market losses. Qualified accounts drive participation in mutual funds and target date funds within the plan. And with that participation comes higher long-term investment costs. Unbeknownst to most, plan participants are not just paying for a fund expense fee. They're also paying for the administration cost of the plan. They're paying for the audit cost of the plan. They're paying for the enrollment cost of the plan. All of those costs of running the 401k plan are being removed from the participants' accounts each month through an asset fee. And so when we take a long-term look at the effect of these fees, we look at a 45-year-old that's put $500,000 into his 401k over the last 20 years, paying an average of 1.25% in fund and asset fees. That 45-year-old will pay an estimated $405,000 in lifetime account expenses. 80% of what he put into the plan will come out in expenses. We call this pay to play, the cost of participation. Who would have thought it? $500,000 deferred over 20 years, $2.8 million distributed over 25. The owner gets $1.8 million, the investment companies get $400,000, the IRS takes $600,000. Who would have thought that? Qualified accounts entice participants to accumulate large amounts of wealth in a plan that has a high probability of suffering market losses and is inaccessible without severe taxation and penalty before 59 and a half. If there was a better way, when would you like to learn about it? How about now?